Number one, if you don't know your stats, fucking start collecting it, please. Go and understand your statistics. Whether you're a systematic trader, whether you're a discretionary trader, your stats will tell you a lot of things. We want people that are trading in a steady manner, not out here gambling, YOLOing, their entire accounts on one or two trades, trying to just make it big.
I think prop firms are a great way to leverage your capital. And if you don't like prop firms, then don't trade with them. But I think they offer great opportunities for traders. It's the best time in the world to be a retail trader.
What's going on, guys? Welcome back to the Challenge Accepted podcast. It is another really, really good episode we have in store for you guys, talking about something that's extremely crucial. I know last episode we were talking about some numbers and stuff, and there is still some unfinished numbers that I would like to go into, especially with regards to trading a challenge, but actually talking about challenges and how you approach them and how you approach this challenge trading environment, I think is quite a good prequel to that episode. Because if we're talking more in detail about how to manage your numbers, how to actually calculate based on your statistics, how to trade a challenge, that can get a little bit convoluted. So if we start with the baseline, and today we're going to talk about one phase versus two phase plans, something that if you're a prop trader, you're going to be very used to these different challenges. And if you've ever wondered, hey, like, what's better for me? What am I more comfortable with trading, or like what actually is even the difference? Like, we're going to be able to highlight this to you today from the perspective of, someone that's trading these challenges, has done so for a long time across multiple firms, and from my perspective, which is also the firm owner, how we set up these different plans, what the risk structure is like, so you can have a more comprehensive understanding of why these plans are shaped the way they are and how you can take advantage of the slightly different trading environments that you might see in these two. And maybe if we have time at the end of this episode, we can go a little bit into the data, taking a look at certain risk calculators or taking a look at certain ways to manage your numbers risk-wise. But that could also be a whole nother episode on its own. So we'll just get into the basics first, and then we'll start building on top of that. If we got some time, we can go a little bit deeper. So for this episode, I want to kick things off by asking James, because we just had this conversation off camera or off stream about one phase versus two phase. James, what is your preferred challenge parameters, right? Talking one phase, two phase plans, and why in all the across all the challenges you've traded?
Yeah. So just to get into it before I answer, I want everyone to know that my pass rate for challenge is less than 50%. It's just under 50%. So for those that are listening to this and expecting to pass every single challenge that they take, it's just unrealistic. I definitely think that a lot, if you got above 50%, you actually do pretty good. I've got a less than 50% pass rate, but when I do get the accounts over the line, I'm making way more than what I'm spending on the challenges. That's the goal, right? Once you got the account, just take the payouts. I don't swing big on once I got the funded accounts, I'll take my 2-3% profit, and then I'll take my payouts. But yeah, I think it depends what you want to do, right? I do like the one phase static drawdowns. The thing I do like about the one phase, you only got to pass it once. But the thing I do like about the two phase is that it's got like a 1-to-1 risk reward ratio. What I mean by that is, if you are like for Haja, you got a 9% pass drawdown and you got a 10% profit target. So essentially, that's almost 1-to-1, right?
Actually, it's better than 1-to-1 on the Hydra side. I think maybe it's like 1-to-1 on FTMO, some of these other firms.
Yes,
But on the Hydra two phase, it's a 9% drawdown with an 8% target
8%.
on phase
Apology,
one.
8%.
And
yes.
then on phase two, it's a 9% to 5%, which is actually it's like an inverse ratio, right? Like you had more risk than your profit target.
Then your profit target. Exactly. So that's what I do like about the two phase, right? And you can be a little bit more aggressive, because I think with Haja, you got 6% max drawdown on the one phase, but with the two phase, you got 9%. That extra 3% does make a big difference. For example, if you're down 4% on a one phase, you only got 2% left, but on a two phase, you got 5% left. So for me, it just depends what you want to do. If you want to be maybe slow and conservative, I think a one phase is good. If you want to be more attacking and try and pass it a little bit quicker and be more aggressive in your drawdowns, in your risk, I think then the two phase is good for you.
Yeah, so maybe we can take a look at, let's just compare the plans a little bit, and we'll dive a little bit into some of what I think are the key differences between one phase and two phase. And I'll also give you guys some insight into the numbers, right?
Sure.
Because we've been running Hydra for over 2 years now, and statistically speaking, we sell about an even number. It's very close. The people that choose two phase and one phase, it's probably split somewhere close to right down the middle. But with our one phase plans, the we know that the pass rate is significantly higher, and that should be obvious because you only need to pass once, right? So from a firm perspective, one phase plans are a little bit riskier for the firm because more traders pass. There's a reason why one phase plans are priced slightly higher than two phase. If you compare, let's say, 100K one phase, we're doing 750 for the base plan here on the one phase, but for the two phase, it's significantly cheaper at $500, right? So, like there is this price difference which you should take into account. And this price difference is a reflection directly of the amount of risk that a challenge account poses for a firm, right? Because once someone is passed, we are liable for payouts, whether
Yeah.
we are hedging this trader out to market or not. It ultimately doesn't matter because if we hedge, we have risk on the losing side. If we don't hedge, we have risk debooking a trader. So it almost doesn't matter, from a more eagle's eye point of view. Like either way, once someone passes the challenge, obviously, like there's open risk on the table now, right? So the firm is liable to lose money one way or the other potentially. So anything that's easier to pass obviously is going to have a price premium on it, and you'll probably see this across any of the other prop firms out there as well. Probably follow a very similar pricing structure in that one phase plans usually tend to be more expensive slightly
Yeah.
than two phase plans, and this is a direct reflection of risk. So that's the first kind of point of comparison that you can make between the two, which is there's one that is statistically easier to pass because we have way more people passing it, right? This is irrefutable. It's not like my opinion. It's just statistically, data speaking, easier to pass or more people pass it, and something that's a little bit harder to pass, but maybe slightly cheaper. And potentially, you can also say that one phase you could pass faster, two phase, even if you pass phase one really quick, you still got to pass phase two, right? So, you have to take into account when you're choosing which one. That should be a consideration, right? But I
Yep.
think that um in comparison to what James was talking about, this is probably a smaller consideration. I think as a trader, your biggest consideration should be the max overall loss on these plans,
Yeah.
which, different firms do different things. But over at Hydra, it's relatively straightforward. The plans are almost exactly the same, follow the same rules. There's no like big differences between the two. I think some of these other firms have like so many different plans going on. I don't even know what the difference between the rules are, right? We try to keep things as simple and as straightforward here as possible.
Yeah.
Plans are almost identical, and the main difference is the max overall loss. So you can see on the one phase over here, we got 6%, right, to work with. And then on the two phase, you have 9% to work with. While on the single phase, you have a 10% profit target. And on the two phase, you have 8% on phase one and 5% in phase two. So the ratio is much more favorable
Nice.
on the two phase plans, right? So, you can risk the way you can look at this is you can risk 9% to make 8% in phase one, and you can risk 9% to make 5% in phase two, right? This is just a very simple way of looking at it. You can't actually trade that way because of the max daily loss, but you can use this as a view, right? Like you're getting better than 1-to-1 odds on what you're able to, let's say, leverage on the two phase plans. Whereas for the one phase plans, it's very much the opposite way around. You have a profit target that's, significantly higher than what you have to work with. So it's an inverse ratio. What we have is an inverse ratio. And I think this is one of the most favorable trading environments for people that understand and really truly understand how to utilize risk, know when they need to be aggressive, know when they need to step up their risk. For example, what James is talking about, right? For someone like him that wants to trade aggressive on the challenges, doesn't mind losing, challenges, doesn't mind just trying again. He just wants to get this phase over with. He's not trying to trade, a challenge account for 6 months, right? He's trying to get that over with and then start to get conservative when he gets to the funded phase, because that's when you're liable to make payouts. So, for someone like him that, understands how to use aggression and understands how to tone it back, I would say actually two phase probably is more favorable for him, because you have to take into account, right, that if you consider the funded step as a phase, the funded step follows the same parameters as
Mm.
whatever challenge you have. So your funded account on a two phase has a max 9% drawdown,
You have more money to
which
play with.
is significantly higher than the one phase plan. Like 3% extra is a lot of wiggle room to
Yeah.
play with, right? So
Want
you need to take that into account. So James, what are your thoughts on this? Like, when you look forward to kind of trading the funded accounts, now I feel like a lot of people just look at this as like, oh, I just want to look to pass, right? But I think you need to set your sights a little bit further down the road. What are your thoughts here?
Yeah.
Would you rather pass faster and have less wiggle room to work with, or would you rather say, hey, like, it might be harder for me to pass this, but when I do pass, I actually have more drawdown I can use?
I do agree. If you have, I mean, when you got the funded account, you are going to have more. I think the first thing I would say is don't be scared to fail, because as I just mentioned at the start of this, I pass less than 50% of the time. But once I do get the funded accounts, I'm keeping them for a good number of months and taking a good number of payouts on them before maybe I've dropped the risk down completely, because now I'm able to make money on 200K, right? If you're making 1% on 200K, let's say I paid $1,000 for the account, I'm making more than that on one payout. So if I have 5 payouts with them, I'm 5 times my money essentially. So, yeah, it just depends on what you like. I think I will say this is that the nice thing about Hydra's one phases is static drawdown. A lot of the times you'll see across the industry, one phases are trailing drawdown, which I'm not an advocate for. I would say completely stay away from that. Trailing drawdown is not great. I see a lot of the futures firms have trailing drawdown. It's a lot more harder. It's more tough, because if you go up, then the drawdown trails up your balance. I don't like that from the trading drawdown perspective. So I do like that with Hydro, the one step static drawdown. But yeah, other than that, I think if it depends what you want. I do like the two phase. I also like the one phase, but I do from a perspective of being aggressive. If I'm looking to trade conservative, I might take the one phase because I got to pass once. If I'm looking to trade aggressively and get the challenge over within a month, I'll look to take the two phase because I can attack and have it's a less than 1-to-1 ratio, as you mentioned, drawdown to
Yeah,
profit.
that like inverse risk reward ratio,
Yeah.
it really starts to play in your favor if you really want to just get aggressive. And I think, if you're maybe from the mindset of like, hey, like I just kind of just want to take one shot, you almost maybe taking I know, and I actually advocate for, beginner traders or traders that are less experienced to do this, is treat your challenge as your demo account, right? So your goal isn't necessarily, I want to pass this as quickly as possible. You might say, hey, like I've done a lot of back testing, I've done demo trading. I want there to be something on the line. I want some skin in the game, right?
Yeah.
But I'm also not super confident in myself. And I just want to build confidence. I just want to collect data. Maybe I want to collect a few hundred trades worth of data. I want to trade for 2 or 3 months and really like use this as a way to solidify myself. I'm not in a rush to pass. I'm not just trying to maximize my earning potential because I don't even know if I'm long-term winning. Then maybe that's what you go for. You go for the one phase because you don't need that additional risk. And
Yeah.
the fact that the one phase is a little bit easier to pass, right? You might just get to that funded stage quicker, which will be a boost to your own confidence and will be a boost to kind of, your ability to trade and start to make money, even if you eventually blow it. Right. And I think what James said, it's important. Yeah, I really don't think trailing drawdowns are any good. Like I wouldn't purchase a challenge of any price with a trailing drawdown because you are never essentially able to risk more on the because
Exactly.
we forever just have this balance to work with, right? Let's say on a Hydra account, let's talk about the funded phase because, when you get to the funded stage, right, like you want to be able to, let's say if I'm up, a few percent on the account and I'm green, like why shouldn't I be allowed to risk more?
Exactly.
let's say I'm risking 0.5%, grinding my account up, and now my account's up 5%, and I really want to bump that risk up like 1%. I've built a huge buffer for me to work with. So now that 1% risk isn't as risky as when I started with the initial balance, right? But with trailing drawdown, this is not possible. You can't do this because that drawdown is following you, right? So that's another consideration that you really need to take. I do not believe in trailing drawdowns whatsoever. Like, just from a trader's perspective, it's a huge negative. Do not underestimate how much a trailing drawdown can mess with your overall results, because it is one of the most restrictive things you can do as far as like making a trader manage risk a certain way. So I would say, yeah, look for plans with just static drawdowns so you can build buffers, you can manage your risk. Once you've made profits, I think that's how it should be, right? If you're up on a funded account, like, why should I really, like, apart from that max daily loss, you can manage your account however you want. You want to risk 1%, 2% a trade, right? Like, there's nothing stopping you from doing that. Whereas with a trailing drawdown, that's just not possible. So
Agreed.
I think we
Just to
yeah,
just about
talk about some.
now,
Yeah.
yeah, I also think what you're saying about that able to risk more, it's kind of like a gambling tactic as well. Like, let's say you go to and you're playing red and black, you lose your first one, you double up because if you win, you're going to win your money back, right? It says the same like trading. When I'm trading really well, and I'm not saying gambling. I'm saying this is a tactic that can be used. Let's say you've got a 100K account and you want to risk $500 per trade. Right, per day, right? Let's say you up $500 on the day. Well, guess what? Now you have $1,000 to play with. You can risk now $1,000. Let's say you win the next trade. Now you're up $2,000. You see how you can take that $500 and start risking more on the day because you got a buffer to play with. You can't do that with the trailing drawdown.
Exactly. And that's one of the tactics I think that can be very effective for passing the challenge phase is,
Yeah.
instead of taking just static risk, you up your risk when you start to make profits, because
Yes.
you are essentially just trying to pass as quickly as possible, right? Like, for someone like James, who's confident in his abilities, he wants to pass as quickly as possible. That means, using risk in a manner, with an account that gives him enough flexibility, like, let's say 9% max drawdown, using that to start to create almost like a game within a game that allows him to be able to pass faster, right? Like, that exact example, you make $500 and the next trade, instead of just risking 500, you risk 1,000. And then guess what? Like, let's say you have a 1-to-1, risk reward ratio, and you win that trade. So now you're up $1,500, right? Like, this is something that you can, if you then take that and then leverage that into the next trade, you could be very well passing a challenge within a couple of trades if you do end up, let's say, hitting a hot streak, right? A lot of like this very short term stuff is very luck dependent. So I don't want to say like, hey, like, this is the best way to trade. It really depends. But this is one of the ways that you can utilize, and I think especially for James, someone with a bit of a higher win rate, risking that little bit more on
Yeah.
the next trade, understanding that the probabilities are on his side, he's more likely to win a trade than to lose. Um, that can really play in his favor when it comes to passing challenges, right? If you have a maybe slightly higher risk reward, system, but lower win rate, you might not want to do that because, you're maybe more likely to lose the trade. So it really, really ultimately depends on, your trading system, how you want to approach this. Right. And I think that we actually have some time in today's episode to go into a little bit more detail here regarding the challenges. And we'll take a look at some numbers. We'll look at a risk of ruin
And
calculator. So,
do I just want to for the guys that are watching this, that previous page that you had up there, where can the people find that? Where can
which
the
page?
viewers find the page there with there we go at the bottom there. Sorry, let's add to stage. There we go. At the bottom there, if you go to the bottom, if you can just show where you can find the difference between the 1-step and 2-step on the website, all the way at the bottom.
Oh, here?
Yep, there we go.
Yeah.
Okay. So you can see the difference between the one-phase plans and the two-phase plans. So if you go to the Hydra funding website, scroll down to the bottom, you can see the difference between the one-phase and the two-phase accounts and see that out for yourself.
Yeah. So if you want to compare things, it's very straightforward. Like really, these are the same, same challenges. Uh, the other difference is leverage. I think we should cover this before. I almost forgot about
Yeah.
that. There is a difference in leverage. So leverage. Wow, leverage is almost like a topic on its own because I feel like this leverage is probably, in my opinion, the most misunderstood topic
Yes.
by beginner traders.
Yep.
Would you agree?
I agree 100%. I think, yeah, beginner traders get it completely. Yeah, I don't think they understand what leverage is actually.
Yeah, like
Yeah.
they're always coming at from the point of like, how much leverage do I get? Well, it doesn't matter how much leverage you get. Honestly, like it doesn't matter. The only thing that should matter to you is how much risk are you putting on every trade, right? And what is the size of your stop loss? For example, for me, like I've been trading higher time frames, for the last like since September now for the last 3 months almost, August, September, and I never even come close to touching the 1 to 20
Oh,
leverage max. Like it is
that's what I was gonna
never
say.
like you know
I
it,
on yeah. On my personal accounts, I've never even had that message that says you can't not enough money because you can't enter more because you over leverage.
yeah,
Basically,
because you like maxed out your
if
margin.
your total exposure is over 20%, you're probably gonna blow an account anyway. But that's like if you got a 1 to 20 leverage, and you're risking 2%, 1% of trade, you're not gonna have an issue, really.
No, you're really not. The only time where I see, when I and this is on a practical level because I've traded very low time frames before, like scalping and stuff. If you have very, very small stop losses, that's when, that 1 to 20 might start to be a little bit limited because your stop losses are so small that like when you risk 1%, you are able to use a massive amount of leverage. But there's a reason I don't trade that way anymore either because the more leverage you use and the more leveraged out you are, the more you start to get affected by things like slippage, like spread. Because when your stop losses are that small, right? Let's say you have a 3 pip stop loss, right? Like which is tiny, like a 3 pip, 2 pip stop loss, even or 4 pips, single digit pip stop loss. Like let's say the spread is 0.3 and you have a 3 pip stop loss. That's a 10% increase just based on spread. And a 0.3 spread is nothing ridiculous. It's like, on most pairs, you're going to probably experience that. Right. And you're going to experience slippage as well because you're using very, very high volume and you're expecting that stop loss to get met. And I can tell you that under live market conditions, you're always going to experience some slippage. And this is why some people are like profitable on, trading tiny stop losses on paper. But when they execute in live markets, a lot of things can happen. I don't think that I think that if you're constantly on the need, or let's say if you're like just like, oh, like 50x leverage is not enough. I don't think that you're making money trading. I mean, I'll go on a limb here and I'll say I dare to bet that if you're like I can't trade 1 to 50 leverage, it's too little. I You're either not managing your risk properly or, like your stop losses are extremely small. And even then, you're probably risking a lot. I've done enough. I've traded enough where I know what these numbers exactly look like. Like I've
Yeah.
been the guy that's like, okay, I'll only trade EU for zero spread, like all this shit. And even then, like slippage does start to affect me on certain trades. I've lost as much as like 3 times my risk on, slippage and spread combined because I'm using so much leverage. And
Yeah.
it's just never the trade that you draw out on trading view, like it isn't like you get slipped a little bit and
Yeah.
then, spreads a little bit. You're execute like maybe the books are a little bit thin, right? Like you start to get your orders filled at different prices. You end up at a different price, and suddenly instead of a 1 to 5 risk reward, you're looking at a 1 to 2. Like it happens. It's very easy for that to happen. And that's part of why I switched over to trading, kind of higher time frames. Like this shit just doesn't matter. Like when I'm executing on a 1 hour chart, yeah, slip me a little bit, whatever the spread is, like it's not gonna affect my risk reward and my trading that much. And I find that like a lot more chill. And yeah, my need for leverage is I never even come close to touching the 1 to 20. It just
Yeah.
it's not a thing for me. So maybe for someone like me, trading higher time frames, right? One phase challenge, I don't need that 50x leverage. But if you are a scalper, if you have very small stop losses, that's when that like two-phase leverage 1 to 50 starts to come in. And again, right, like from the firm's perspective, just being transparent, uh, because the two-phase challenges are much harder to pass, less people pass them. We're able to offer more leverage because leverage increases risk, right? Increases volatility on the back end for us. You're able to risk more, take larger positions. So again, that's why there's a difference between these two. But, realistically speaking, the 9% max drawdown, the higher max drawdown and the higher leverage kind of tie together because, if with the higher max drawdown, maybe you want to risk a little bit more. So we'll give you a little bit more leverage so that you can risk, maybe you want to risk 2% or maybe you even want to risk 3%. I mean, I personally would never do that. That's crazy. But maybe you want to do that just to pass the challenge. You might need that 50x leverage to do that. So everything we do is kind of based on like what we expect traders to do, and how we approach this is based on a reasonable trader that's not trying to game the system and come in and
No.
gamble, right? Like if
Yeah.
you're a responsible risk manager on a 9% max drawdown, we don't see anyone needing more than 50x leverage. It's simply
Yeah.
not necessary, right? Unless you're coming in and you're risking, the max daily drawdown 5% per trade, then the real question is, do I even want you trading at my firm? Because
Yeah.
that's not the kind of risk management that we look for.
I've been seeing a little bit of that stuff online. Maybe you can speak on this, but I've been seeing where guys come in, they'll risk the max daily loss per day, like 5%, so just under 5%. And then they're getting told, like, listen, they can continue trading at the firm, but you can't risk more than 1% per trade. I think that's pretty fair. Like they're saying to you, adjust your risk. Like, listen, like they're also going to protect themselves. This is the thing I think about prop firms. I think prop firms are great for traders to leverage themselves, but you're also going to, it is a business at the end of the day. They're going to make money as well. They don't start money to give. It's not Father Christmas, right? They're going to make money as well. That's not giving to everyone. Can you make a lot of money with prop firms? Yes, you can, but you also got to play by their rules. If you're going to trade with them, if you don't like their rules, go to another firm, right?
Yeah. I mean, like we do look for things like this on the back end. And I think we're one of the firms that's like we take the risk management side very seriously. And anytime you're not just like a straight B book firm, and I think even if you're a straight B book firm, like you have to take this very seriously because if we do hedge a trader out, he's trading with live capital, and we are liable for losses. So we have algorithms, we have things that are monitoring everyone's trading behavior. So when you're funded, like we know when a trader is just out here YOLOing the max. Like no good trader, no good long-term sustainable trader is risking 4%, 5% per trade.
Yeah.
It's nuts. Like your risk of blowing an account is extremely high. So, while there is this max drawdown rule, the daily max rule, right? This rule is more so to say, hey, like put a stop on your trading. If you're getting close to it, like just don't trade anymore for the day, right? Like it's there to be like, hey, you lost a couple trades that day. It's not there to say, hey, this is the max that you can put on a trade. Like, good luck.
Yeah.
So we do actually do that. And I'll tell you the truth, right? Like what we do at Hydra, and I'm not sure if other firms do this, I'm pretty sure they do, is if we notice that there's someone that comes in, funded trader, he starts to YOLO size bets. Like we know when you're taking max position size, max risk, maxing out your account on any given trade, and if we see that as a continuous pattern, we will never take away your funded account. Like your funded account is yours and it's earned, and you can do whatever with it. Like you're within the rules, so good, you can keep that. But we will not allow you to buy any more challenges. We say, hey, like you can continue trading any existing accounts that you have, but you do not espouse the risk management behavior that we would like to see from the traders at our firm. And, like, unfortunately, we don't want to do business with you because this type of trader is impossible to manage on the back end. Doesn't matter if I'm A booking or B booking you, you are a huge liability for us, right? Because you are just looking to gamble.
You're going to wipe them out.
So I would rather say, hey, like, you can do this, maybe some other firm will accept it, maybe whatever, and you can continue trading your account. But like we're not going to let you buy any new accounts, and like whatever happens with the existing ones is that, like, that's kind of it. Like we're not doing business with you anymore. And that's kind of our approach to traders that are very, very high risk, very, very prone to using max leverage and stuff like this. So don't think that just because you're playing by the rules, and I'll tell you guys another thing, all right? Like, firms like us, like, the prop firm industry is growing. Firms don't work in a silo anymore. Like, if I have someone that I know, like, is potentially blacklist behavior, your name is going to end up, your email, all your shit is going to end up with other firms as well, and it's going to impact your reputation and your ability to acquire funds across other firms,
Yeah.
because we share the list. Like, the tech provider, at least, we don't directly share that, but via the tech provider, they are building um,
Database.
the database for
Yeah.
blacklisted traders, right? Because they want to protect all the firms that they work with. Like, that becomes a part of their whole spiel of, like, why you choose them. Is like, hey, we have measures in place to protect you from bad actors. Like, we can recommend that, like, for example, these traders that are risking to the eyeballs, we can make sure that they're not able to purchase plans with you. So as we go along further in the industry, if you cement your reputation as a trader that is just out here to gamble, I think it's going to be harder and harder for you to find funding, because the legit firms that are on the market, like, we want sustainable traders. We want people that know how to manage risk. We want people that are trading in a steady manner, not out here gambling, YOLOing, their entire accounts on one or two trades, trying to just make it big, right? So definitely a word of caution, to you guys out there. Like, prop firms are not stupid. Like, we have all this data. We know what you're doing. All right. Like, and I don't think it's a big ask to just be a responsible trader. We're not saying, like, hey, risk 0.2%. Like, risk 1 or 2%. Like, do what you want, like, within reason. But be aware that, like, that if you're caught kind of like trying to game the system, or trying to uh like, play with it in some type of way, that there are consequences to it. And different firms deal with things differently. I think we've taken a very fair approach, in the sense that, like, we still uphold our end of the bargain no matter what. That's a very big ethos that we have. But maybe other firms, they'll just straight up shut down your account and say, hey, like, you're done, goodbye, like, we're not even going to pay you out on the money that you made because of this. Like, we've all heard stories like this. Traders get denied payouts. We don't do this. We don't deny payouts. We pay what is due. We do what is right. But we have the right to say, hey, no more accounts for you in the future. And I think that's a fair way to go about, saying, these are the types of traders I don't want in the ecosystem. And, companies have a right to do that. We're private businesses. We don't, we manage our own risk. We manage our own rules. And if you're not the type of trader we want to see at the firm, then we have the right to refuse your service, whether you'd like it or not. Right. Like, so maybe you're going to have to look for other firms, maybe, and a lot of the good firms, we share the same kind of tech providers, across us. Like, we're starting to be able to utilize, like, risk management databases and stuff like this. So it's time, it's high time you need to be aware of your own risk management practices. And I hope that you do choose, like, you have to choose a firm, and you make sure that a firm's not doing shady shit also, right? Because they could just look for reasons to, like, just take away your account and not pay you out. You don't want to be at a firm like that, right? You want to make sure that the firm that you're at is honoring their end of the deal. And even if there's a disagreement or whatever, like, whatever was agreed upon should still be honored. That's always been our take here, right? Like, you earned your funded account fair and square. You didn't break any of the rules. We're not never going to take away your account or deny your payout, but we can say, hey, like, this is it. Like, no
And
more,
yeah, we don't want to work with
right?
you anymore. That's fair.
Yeah.
100%. Yeah. No, I think this has been really good, Diwa.
Yeah. Just real quick, I think we can touch on this in
Yes.
a couple minutes left here. I do want to get into this. Since we talked all about, like, this max drawdown, I do want to get into, like, this risk calculator tool, and talk a little bit about risk of ruin, because risk of ruin is a concept that I got really familiar with during my poker days. I don't know if I can open this calculator because I don't have my VPN on right now, but let's see if I can find it. But essentially, risk of ruin is what are your chances of destroying your bankroll, right? In gambling, it's your bankroll. In trading, it's your trading account, and in trading challenges, it's your max drawdown, right? Like that's the difference. Like you don't have the whole account to work with. So let me just see if I need to get on VPN. Hopefully, I don't disconnect here. Let me just try and connect.
Hey, do you guys head off? We can just edit this out.
Right. I disconnected for a second, but now we're back, and I'm going to do the. I'm going to share this one with you guys. This is a really, really great tool. So, this is what you call a risk of ruin calculator. So,
Yeah.
you'll be able to plug your numbers in here and really start to understand like how likely you are to blow an account. I think this is something that you should evaluate for yourself, right? So, for example, in my system, right, I have about a 39% win rate, and my average profit and loss is 2RR. And if I was risking 0.4% per trade over, let's say, 100 trades, and the max drawdown, like for example, on the Hydra 2 phase is at 9%, right? If I
Yep.
calculate these numbers, my risk of ruin is only 0.684%, which is very reasonable. It's less than a percent. That's what I would shoot for. Like, I'm a more conservative guy. So I would not be risking anything more than 0.4% per trade on my challenge if I was doing a 9% max drawdown. Now, let's change this to a 6% max drawdown. And let's see, like that goes up to 4.6%, right? So that starts to be a realistic likelihood even though it's low. And now if let's say you say you're risking 1% per trade, right? Based on my win rate, the risk of ruin is 31%. So
Yeah.
pretty much 1 out of 3 accounts I'm guaranteed to blow. We're like risk of peak to valley drawdown is like over the 100 trades how likely you are to experience this max drawdown. Risk of ruin is how likely you are to touch that from the initial balance. Right? So this is just a tool that you can go take a look at. You can just find it on Google, like risk of ruin trading calculator. The one I use is from cashbackforex.com. So if you're interested in kind of playing around with this, like you can plug your numbers in. I think I know like James is around a 70% win rate with like a zero point 0.7
Yeah.
RR, right? That's a zero point 0.7 or
So,
you know,
a little bit more.
yeah. So let's say on a 9% max drawdown, like his risk of ruin risking 1% per trade is only, 0.934%. Right?
If
So
I'm risking 3%, will go up, right? A lot. So
yeah, so if you even if you risk 2%, it's already gone up to 6%, right? If you risk 3% per trade, that's gonna end up being 15%. So you can start to play with the numbers a little bit, right? So if you were on a one phase, obviously, like I don't think you need to know that like if you're risking 3% per trade with only 6% max draw, I don't know how likely you are to blow an account. But you can start to just mess around with this a little bit if you know your stats, right? You can come in. I strongly advise you to number one, if you don't know your stats, fucking start collecting it, please. Like there's Tradella and stuff like this now. I used to have to do it on Notion manually. Like I used to collect my journal my shit. Um, Now there's stuff like TradeZella, go and understand your statistics, whether you're a systematic trader, whether you're a discretionary trader, your stats will tell you a lot of things. And if you have a good enough sample size, let's say a couple hundred trades, you'll be able to rely on that data to help you make decisions, hopefully make smarter decisions when it comes to things like purchasing a challenge, right? Like, and you can start to game plan yourself because trading a Forex challenge or trading a crypto challenge with prop firms, it's almost a game within a game, right? There's the rules and the parameters, and you almost have to decide, like how James did, based on his approach. He doesn't mind losing, like 50% of the accounts that he buys because he knows he's going to make money off the back end. That might not be your approach, right?
yeah.
So you have to decide and game plan for how you want to play this game and understand and try to have the numbers and the probabilities in your favor, as is trading. Trading is a numbers game. You want things to be in your favor. You want the coin flip to favor you, right? We're still flipping coins at the end of the day, but we're all trying to flip a coin that favors us. That's really it. Yeah, James, do you have anything to add to this?
No, I think this has been good. I think prop firms are a great way to leverage your capital. As an individual, I think, and if you don't like prop firms, then don't trade with them. But I think they offer great opportunities for traders. It's the best time in the world to be a retail trader. That's just my take on things. And I think
just made our biggest payout of the year.
did.
I just got paid out almost $34,000, and he did it on a 100K account. It's made, I think, 40 grand plus on a 100K account. This guy traded only Bitcoin. He's obviously done well this run up, and he got a 30,000 payout, which is nothing to scoff at on a 100K account. That's
massive. Oh, of course, bro. For anyone, that's serious, though. I mean, let's just put this into perspective. The average salary in the United States is, I think, if I'm not mistaken, is in the mid-40s. He just made someone American average salary in one payout with a prop firm. So, yeah.
And it wasn't on some massive account. It was just a 100K challenge. So,
Yep.
like this is the type of thing that is possible. And he's still trading his live account. Like like from everything I know, he's been a very reasonable trader. I hope he continues to make money with us. And this is how you got to play the game. I hope like today's episode has given you some insight into how these challenges are set up, why they're set up in a certain way, and hopefully able to help you figure out which one is right for you. And I hope some of these like insider tips are going to be able to help you make some better decisions so that maybe you start making money a little bit sooner with prop firms. And yeah, as always, you should trade with Hydra because we're the best. Just saying.
Yep. Love it. No.
Thanks for tuning in, and we'll catch you in the next episode. Peace.